QuickBooks Pro Desktop 2021. Multiple currencies, invoice, and accounts receivable in foreign currencies. Let's get into it with Intuit. QuickBooks Pro Desktop 2021. Here we are in our multiple currency file. We currently have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list. In a prior presentation, we set up the multiple currencies, which you can do by going to the edit dropdown, preferences, and the multiple currencies, company preferences, turning on the preference, noting that you can't turn it off in that particular company file. That's why I recommend using the test file to test it out as we're doing here. Then you will have the lists drop down and you will have the currency list within it, which we now have and are opening up. Our home currency is going to be the US dollar, so that's our measuring tool. That's what we measure our financial statements in. We're going to be doing a transaction where we sell to a customer who will be paying us not in our standard currency, but in the Canadian dollars. So that's what we're going to do. We're going to go to the home page. I'm going to set this up in Excel as well. So we'll have an Excel worksheet. I'll provide you with this, but you don't need to have the Excel worksheet to kind of follow along. So we could just think about it in terms of how the accounts are going to be going up and down, how we would calculate this out in terms of an exchange rate, and then we'll enter it into our system. So if we made a sale in QuickBooks, we would think of that as an invoice, meaning homepage in QuickBooks, we would be creating then an invoice. So if we were to be making then an invoice, what's going to be the accounts that will be affected? Let's just think about it in increases and decreases in accounts. We're not going to deal with inventory right now, so we're just going to say it's a service type of item, and we have the invoice. Then what will typically increase is accounts receivable. Now we're going to be receiving money in foreign currency, but still it's a receivable that will happen in the future. So we're just going to pick up the AR, but we want to make sure that we're picking up the accounts receivable in foreign currency, the foreign currency receivable. And in QuickBooks, we set up another account that will help us to track and value that receivable account. The other side then is going to go to revenue or sales, increase in the revenue account when we make the sale. So those two accounts are pretty straightforward, except that we have the accounts receivable that's in foreign currency. Now, when we put the amounts in there, however, that are going to be shown on our books, even though we're going to be paid in the future in foreign currency, in this case, 42,000 Canadian dollars, I'm not going to put it on our books in the Canadian dollars. We have to revalue it to the US dollars, just like we would with any other kind of transaction that was, like if we were buying stocks or something, like we'd have to value it in dollars. So we're getting 42,000 units of something, Canadian dollars, in the future that we need to value in terms of US dollars. So we use what we call the spot rate, and that's the exchange rate in the current day, the current day's exchange rate. In other words, we expect to get 42,000 Canadian dollars sometimes in the future, possibly within 30 days, if that's the term of our receivable. We're not going to try to say, what is the rate, what will the rate be in the future? What's the future rate that we predict it's going to be? We don't know that. That would be a projection, but we could, there are people that are projecting that. But in this case, we're going to use the spot rate, the current exchange rate, even though we haven't not yet received the dollars. We have a receivable, an asset on the books that for Canadian dollars, 42,000, that we're going to convert using today's spot rate. So we're going to assume the spot rate is 0.65. This spot rate is something that can be helped or utilized within QuickBooks to tell us what the spot rate is. So that's a nice feature within QuickBooks. We don't have to look it up basically all the time. And then we're going to say, all right, this is going to be the 42,000 Canadian dollars times the spot rate. That means that's an equivalent of 27,300 in US dollars. So this is a Canadian receivable. We're going to get 42,000 units of Canadian units, but we're valuing it on our books in US dollars. That's what's going to go on the financial statements. That's going to be the debit and the credit. So the transaction here will simply be a debit or an increase to the accounts receivable. And it's not in foreign dollars, it's in US dollars, even though it's in the Canadian dollar account, representing the fact that we're going to get paid in Canadian dollars. It's valued in US dollars. And then the sale also, of course, valued in the US dollars because our financial books are valued in the US dollars. Okay, so let's see how to do that in QuickBooks. If I go back over to QuickBooks, now I'm going to close out the invoice before I populate it because I do want to look at the rates first. So I'm going to close this back out and I'm going to say, okay, this is going to be something in Canadian dollars. So let's first look at the currency list over here. And I would first want to populate the current rates if I was doing this in today's time period, but I'm not doing it in today's time period because it's a test file. So the first thing I might do is go back on over here and say, give me those historic rates. Download the exchange rates, which we had already done. there are the current exchange rates. Now, those are going to be the exchange rates that will automatically be populated and convert from the foreign currency units, the 42,000 in our case, to the US dollars. Now, because we're doing this problem in the future, I have to manually input a rate so that we can put it in the future. So if we were doing it as of today, we would just use this spot rate that's being provided by QuickBooks. It's great. You just need to make sure you update the rate and when you enter in the transaction. I'm going to double click on this Canadian dollar then, and I'm going to make another rate as of the future. So this is in the future as of the time I'm recording this. I'm going to work this problem in the future. So 31 X1 I'm going to say on 03 01 21, which is a future date for me. I'm going to say that's going to be the exchange rate of 0.65. 0.65 is the exchange rate. So 0.65. And so then then when I enter the invoice, it's going to be pulling this exchange rate based on that date, which is a future date rather than the current date. So I'm going to say, okay, now let's check that out. I'm going to go to the home tab. Let's create our invoice now. I'm going to create the invoice. And then I already set up a customer. That's the customer one, which is using the CAD or Canadian dollar as the customer. So we set them up as a Canadian dollar customer, meaning that customer pays us not in our currency, the US dollar in our case, but in the foreign currency, the Canadian dollar as is indicated here. That means the default account will not be the receivable in US dollars. It needs to match, which means it should pop on over to the receivable for the Canadian dollars. So then I'm going to put the date here. I'm going to say this is going to be 030321. So you've changed the date for this transaction. QuickBooks has a different exchange rate for this date. The new rate, home currencies, will be updated in this transaction. Yes, I want you to update that. So it's going to change this exchange rate, which is today's date exchange rate, to the one we populated based on that date. So that's going to be the same exchange rate, so it'll match up with our practice problem we entered here. So then I'm going to say, I'm just going to make up an item. So I'm going to set up an item, and I'm going to call it item 1. And I'll say save, and this is going to be a service item. I'm not going to deal with inventory here. And I'm going to say it's for $100. And the income account it's going to be going to, do we have sales? We don't have one set up yet, so I'm going to set up an account for sales tab. That's just going to be our revenue account. This is a standard revenue account. It's going to be an income type of account that we're going to set up. So that's going to be the increase on the income statement. Notice there's no currency thing that I need to set up here because it's on the income statement. It's not a receivable, payable, or cash account. So I'm going to say okay and save on that. So then we have the 153.85. So I'm going to try to match this out here. I need the 42,000. So I'm going to say this needs to be 42,000 divided by the 153.85 divided by the 153.85, and that would give us about, I'm going to say quantity 272.99317. And that's going to give us our 42,000. Now, obviously, in practice, we would have the item first, and then the number of units we sold that would then be calculated. But I'm backing into that 42,000 for the units that we sold to tie into our practice problem over here, and that's in foreign units. So basically, we're selling inventory and we're going to be receiving 42,000 Canadian dollars, which is driven by our item, which of course we set up the item in our currency. So it does that basically conversion for us. So typically we would know the number of units that we would sell, and then it would do basically the conversion for us. So now we have the information here of the 42,000 that is the amount that we're going to receive in foreign currency, but we're going to be putting it on our books at the 27,300, which matches what we have here, the 27,300. So what is this invoice going to be doing? It's an invoice. It's going to increase the accounts receivable. Is it going to increase the accounts receivable by the 42,000, the amount we're going to receive? No, because we're going to receive that amount in foreign currency, in Canadian dollar units. We need to take those units and revalue them to our units, which is going to be in US dollars, to put it on the books in US dollars, which is the 27,300. And of course, we're using this exchange rate, which we populated as of that date to do it. Therefore, it's going to increase the accounts receivable by the dollar amount, current US dollar, 27,300, even though we're going to receive 42,000 Canadian dollars. The other side is going to be increasing the sales for the 27,300. So let's go ahead and save and close that, and it's going to be in the future. That's okay. So then let's go to our reports, go to the banking or reports dropdown, company and financial. I want to take a look at the balance sheet standard balance sheet. We're going to say, let's do the customized reports up top, changing the dates from 01/01/21 to 12/31/21 and OK. And then in the receivable, there it is. There's the 27.3. I'm going to double click on that. And so there is our item, the 27.3. There's our invoice. And if I double click on that, we're then going to get to our invoice that was set up in the foreign currency units, closing that out. We can see it's the foreign currency receivable. We also have the receivable report by customer. Reports drop down. If I go to the customers and receivable, and I take a look at the customer balance detail, let's take a look at the customer balance detail. There it is there for our customer number 1, which we named them customer number 1 for the invoice. So it ties out there as well. Let's look at the profit and loss. Reports drop down. Company and financial, profit and loss standard, range 01/01/21 to 12/31/21. There we have our sales item there. That sales item recorded in the US dollars using the spot rate as of the point in sale, the point in time we made the invoice, even though we haven't gotten the money yet, either in Canadian dollars or US dollars. And we're recording that in terms of the spot rate for US dollars as of this point in time. So there's that. Now, one other thing I'm just going to add for our practice problem here, we're going to do a transaction to put some money in the checking account. So I'm just going to put 100,000 in the checking account and the other side into retained earnings just to give us a starting point for our practice problem. So then we'll tie out to our practice problem here. To do that, I'm going to go to the lists drop-down, chart of accounts. I'm just going to open up the checking account. I want the US checking account. So I'm going to open up the US checking account. And then I'm going to enter this as of 01/01/21. And I'm just going to call it a deposit, DEP. Going to put this on the deposit side for the amount of 100,000. So 100,000. Other side is going to go to retained earnings or some type of equity account if you set up your company file as something other than a corporation, like an equity type of account. So then I'm going to say record and save that. And it's going to retained earnings. That's okay. Thanks for warning me. But that's what we wanted it to do. That's what I wanted to happen. And so if I go back to the balance sheet, now we kind of line up with our practice problem trial balance over here. We can also check it out with the trial balance, which is a useful tool to use. Reports drop down, company and financials, and then we can take a look at the, accounting and taxes. Look at the old trial balance, the good old TB, 01/01/21, 12/31/21. And so there we have our trial balance, 100,000 in the checking, 27.3 in the receivable, then the retained earnings and the sales, which should tie out here, 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 here. Good. Now, in the future, we're obviously gonna collect on that, and when we collect on it, we might have a different spot rate at that point in time, and or there might be a cutoff date that happens in the future in which we want to revalue our receivable to the current spot rate. So that might be an adjusting entry we would do at the end of the month or year. So those are going to be issues we'll have with that receivable, considering the fact that it's in foreign currencies. We haven't got the foreign currency yet, but we're using the current exchange rate to record that receivable, which again will, of course, change over time.